Hey traders, welcome to Charts and Coffee. Great to have you here. Shout out to Facebook and the YouTubes as well as Twitter. Great to have you here on this shortened week. Debt ceiling, that is the two big stories this week. We have our debt ceiling narrative. Oh yeah, free training room. That's right. Thanks, bot. Hang on, gang. I got to broadcast to one more room. Caffeinate and dominate globally. All right, just bear with me. We have two big narratives this week. And let's see here. All right, so we have two big narratives this week. One is, of course, this ongoing saga, this spectacle of the debt ceiling. Gang, we knew how this was going to end. We've talked about it a lot. Thank you for those of you in our community that we're not panicking. We're not jumping from headline to headline. It doesn't pay us. It doesn't work. And we finally, this is what, the 109th time since 1960, I think it was. So we've been here. We've taken this ride before. We put a quarter in the machine. And it looks like now the bill's going through the Senate. We don't know how it's going to pass. But for the most part, how much, it's not like what we saw in, what was that? And I was doing a lot of research on the history, the last 10 times. Those of you that are This Week in the Market subscribers or my Sector Secrets Mastery members, you have access to This Week in the Markets and the only, frankly, story of the week. Even if we want to add non-farm payroll, Friday's non-farm payroll to this narrative of data and events that are going to affect our week, think adding volatility. Other than, here it is, yeah. So on July 31, 2021, the debt ceiling was suspended until August 1. This is not one of those situations. Generally speaking, historically, anywhere from, let's see, I'll give it to you right now. Following the December 16 vote to increase the debt ceiling, right? We had a sigh of relief rally that took the S&P higher by about 2.5%. Following the October 1 vote, where they upped the debt ceiling just a little bit to buy them some time, that was another 1% increase. And the only sort of dud is when it's simply a suspension of the debt ceiling. And we saw that back in July of 2021. So 2021 was the last time we can refer to that year as a framework for what this debt ceiling, these shenanigans tend to do. All right, so with that being said, that's the big story. And then we've got non-farm payroll on Friday. These jobs, growth, inflation, these data points are really what the Federal Reserve is going to use to justify, that we're going to use to measure what happens next. And for now, it does seem as if there is at least, I think, one more quarter point hike in the cards. I'd say really only that one is discounted. I'm not looking into the future, gazing into my crystal ball. I'm taking a look at the Fed fund futures. That's as close as a crystal ball we have for how Fed words and data are mapping towards what they're going to do next. Those Fed fund futures are remarkably accurate, and they keep us tuned into what's being discounted, not what's being forecasted, right? In other words, this is what we're already expecting. We're not going to play the guessing game of front-running Jerome Powell and company. All right, so as always, if you have any questions, type them on in. We'll take a look at your questions and the markets together. We'll start off with our three main symbols, the S&P, the euro, and we'll take a look at the long bond and see what kind of mood we're in. I mean, obviously a gap up, but again, I'm not looking for just this runaway type rally. Like I said, the movement after it's usually, like I mentioned, what was it? 2.7 to 1.1%. So think about July and October and December of 2021 and the kind of response we saw. 2.7 would be probably the upper end. However, we know that no doubt are we going to start to hear whisperings of 4,400 in terms of where the S&P could be heading to next. Just like 4,200 was the big thing, 4,400 was the August 2022 high. And if we take a look at a chart with 12 months on the view, you'll see that's that next peak. And like any good mountain climber, we're always looking at the next peak. All right, so let's go ahead and jump into the questions. I see them coming on in. And again, gang, remember, I'm not going to let narratives aside from monetary policy really sway what I think is happening next. That keeps the analysis from jumping from headline to headline. You don't want to do that unless you hate your money. and we don't want to be jumping to conclusions about what data means without running it through the filter of what it means to the FOMC. Again, that filter is the Fed Fund futures. All right, first up is editor. Do I see any pullbacks anytime soon in the tech sector? My friend, I will not predict where that, what that is, and I appreciate the question. That is, where's the top? Where do we pull back from there? Where do we retrace? I have no idea, my friend. And here's a little secret. Don't tell anybody. Neither does anybody else. So what we will do is try to find support and resistance. And there was, and forgive me for forgetting who it was that asked, but on my Twitter feed from over the weekend, and by the way, I had a thread about the lessons that I learned from day trading since 97. Now, I was trading years before that, overnight, swing trading, end of day charts, because back then, by the way, in the late 90s, I'm sure many of you remember, intraday charts were unbelievably expensive. So I was armed with my DTN machine, which was just state of the art, right? For the time, we were all getting those little AOL discs in the mail in those little metal flat canisters. But DTN was the way that I got intraday data. And I think that cost me something along the lines of $1,600 or $1,800 per month, right? And now take a look, we get all this data darn near for free. So I don't know where the pullbacks are. What I will say is let's day trade in the meanwhile. So if I'm looking at tech, there's really 4 or 5 symbols we'll look at: QQQ or NASDAQ, whichever flavor of the composite you prefer. And then we'll take a look at XLK, XLC, XLY, and even SMH. So as long as we're moving higher, my focus is on support. Where are the support levels? I'm going to use the automated Darvas 2.0, which anyone listening to me can go get for free. I've made that particular tool, Darvas 2.0, free over on TradingView. Love those charts. I'm on TOS right now, by the way. You can download that for automated support and resistance. I'm going to use my daily price movement ranges, which is a 6-month look back at historical volatility via the price movement ranges based on the day of the week. And that's what I'll use. I'll just wait until price gets there, full well acknowledging that if I'm the batter at the plate, I've got no idea what the market's going to throw at me. I don't know if it's going to be a pitch that I want to swing at or not until price reaches those levels. So that I don't know. And I think the better we just accept we don't have the timing on that and focus then on the zones, we're going to be better off, right? And then we can place an alert at those zones. Use your platform. TradingView is my preference, but use your platform for alerts. Let it babysit price so we're free to continue to scan, right? Or maybe even have lunch. Yeah. Okay. So AMD, Apple specifically, yeah. As far as buying the dip, so to speak, right? Often memed, but it still works, gang. Trend following works. But here's the caveat. The market has to be in a trend. What process are you using to mechanize, almost like a stoplight, almost like a signal where you have indicators that are unbiased? They're just running through open, high, low, close and saying, look, this is a structure that suggests this is the path of least resistance, right? For me, that's going to be the multi-trend, which uses 4 exponential moving averages to sort all that out. So if I'm looking for AMD or Apple, I'm with you. Both of those would absolutely be very good trend following by the dip candidates. AMD is probably closer. AMD is going to rally a bit with NVIDIA. That's that artificial intelligence narrative. NVIDIA, Microsoft, Google, Salesforce. A lot of folks haven't thought about the AI that Salesforce has used. Those are really some of the best stocks that are more common stocks, right? Not more niche, but more common stocks are going to benefit from that. So that's what I'm waiting for, the right pitch. You got it, editor. So well said. Thank you for the question. Following that up with NVIDIA, it's extended. Is it a safe buy? So megawatt, I'm going to extrapolate a little bit. So if I'm way off base, let me know. And you're looking at the 5-minute chart too. Let's tackle both. Is NVIDIA extended? Extended tends to suggest that it has to pull back from here. No stock has to do anything. We used to believe zero was the floor, gang, right? A couple years ago, crude oil showed us that zero, at least in futures, doesn't have to be the floor for anything. So we know that there's no such thing as too low or too high. There just are levels from which we can manage risk, and that's a trade entry. Yes. So is it extended? Absolutely. Can we shorten the time frame? Yeah, I see you mentioned the follow-up of, hey, let's day trade NVIDIA till we get a more substantial pullback on a 1 hour or a daily time frame. And NVIDIA for me, this morning, if I'm looking at the first hour, 9 to 10 a.m., notice once again, I'm using those historical price movement ranges, but this time hourly, studying 6 months of 8 to 9 a.m., 9 to 10, 10 to 11, right? You get the picture. And I would focus on 402.85, but that's only going to be from 9 to 10, presuming we don't put in a higher, lower, low. And then historical volatility will, once again, based on those highs and lows, readjust. That's the way I've formulated this particular tool, and that's its job. But right now, it's looking like it's going to be close to that 402.85 to about 401 and change for the morning on the 5-minute. All right, next up, PK asks, take profit on Lilly or let it run? Well, I don't know where you're in from, PK. So all I'll say is I'm going to presume on Lilly. I don't know. You're short, I imagine. I don't know. Let's take a look at the daily. Again, no clue what your position is. So please remember. So I don't know if you're short intraday or if you're long on the daily. Let's go with the long on the daily. Beautiful uptrend, right? Beautiful uptrend. And depending on where you're long from, right, is what's going to count. To me is, have I had a chance to hit the first target? And if so, I'm going to move to a break-even stop. That way, I'm only risking house money. I'm only risking then, in Vegas parlance, right? We put our capital out. We hit a first target. Now we have an unrealized and realized profit because I like to scale out of 50% of my position. Now I'll put in a break-even stop. Now is the time to get greedy, right? Now's the time to say I had a prudent first target. Now I can get greedy. I'll see what happens from my break even on upward. And it's an uptrend. So I would presume, PK, my thought, again, not knowing where you're in from, my thought would be, yeah, it's in an uptrend. Why get in its way? It's one of the rare exceptions. So let me at least give you the other side of the coin here when it comes to healthcare. Healthcare is right now one of the weakest corners of the major sectors. Major sectors being what? XLK, XLC, XLY, XLF, XLV, and I'll throw in XLI. Those are your major sectors because they're heavily weighted within the indices. Those are top 3 or at least heavily weighted sectors for the NASDAQ, S&P, and Dow. XLV is pretty ugly. So what you've got is a really nice trade in what? What did you do that was so great? I know you did this, but I'm going to brag on you for a second, PK. You found the relative outperformer. Rather than trying to short something weak or in a downtrend, you said, look, what's strong? And I've got a pretty good idea of path of least resistance. Let's go ahead and do it. So I would say if I've got an uptrend, again, depending on where you're in from, yeah, let it run. Let it run. All right, question coming in from our, let's see here. Or I should say a question coming in for UNH. Yeah, let's stick with healthcare for a moment. RPJ. Yeah. UNH, if you take a look at the Dow and really the lack of participation from the Dow at the moment, a lot of what we're seeing on the Dow is the XLV's influence, the number 3 weighted sector, if you will, after financials, tech, boom, comes healthcare. UNH is below the 200 exponential moving average, bearish hemisphere. It's in a chop. It's probably one of the stocks that has caused, in terms of just dragging the Dow down, probably one of the more destructive stocks in that regard. So I would leave UNH alone. I would want to make sure I remember the impact it has on the Dow, heavily weighted, on the XLV, obviously heavily weighted. And I try to find a relative outperformer and just remember that XLV and UNH, until they get going to the upside, they're going to continue to be sort of a weight keeping the Dow and healthcare sector from moving higher. So if it's getting negative news, look, gang, I'm not going to be surprised. Isn't it so funny how usually good news hits strong stocks and bad news hits weak stocks, right? And so below the equator, and mostly with the weakness we're seeing. Yeah, you mentioned there was a downgrade. Yeah, I'm not surprised at all to see that we might push down to lower lows. However, UNH is in chop, right? Bearish chop, but it's in chop. So the question is, how far down will we consider XLV maybe becoming a buy? And I'm going to tell you, with as much strength we're seeing in tech, and obviously we have limited capital to deploy, all of us. Some of us have much larger accounts, some of us have smaller accounts, but we all have limits to the amount of capital we can deploy. And I guess my question is, or my thought is, why deploy it here? Of everywhere I can get to work with a path of least resistance to the upside, let's focus on tech. I mean, that's where it's all sorts of tall and awesome right now. All right, thank you for the question. Next up, Ben asks, I'm short HIBB. Can I take money and run or hold on for more downside? So again, kind of the same thing I'll say about PK's question on Lilly. I don't know where you're in from, my friend, but again, is the path of least resistance to the downside? Oh gosh, yes. We just have, as you can see right here, we had the earnings that came out. And so now what I want to ask myself is, what kind of volatility might the post-earnings environment 1 to 2 sessions provide? Just like we have buy the dip in an uptrend, we have short the rip in a downtrend. So would this be a short the rip? Absolutely. Would I look for more downside? Also, absolutely. Okay, next up, is this a good time to short A? All right, let's see what we have here. Downtrend. What I need is resistance. Let's do this. Let's do this on A. Let's look at it from a different perspective. And that is the perspective of volume, right? I use volume a lot. I talk about volume and volatility quite a bit. Most traders don't. They use price and price alone. Price-based indicators are just going to use some sort of arithmetic around open, high, low, close, which is great. All of us have to look at things like that. But then if you continue to consider the market like an iceberg, at the very surface, which we know is just a small amount of what the overall size of the iceberg is, price is what's visible, but then below that are things like time and different events, which I would tie into time, volume, and volatility. So let's look underneath the surface. And I would like, if I'm going to set this up, I don't have any skin in this game. I don't know that I will, to be quite frank, but if I'm looking at Agilent, I'd like a gap close. I'd like to see it rally to a gap close or to the volume ledge at about 127.40. So yes, I won't do it here. You could. Here's how I would manage risk if you want to short it, as long as it remains below 121.40, 121.50. As long as it remains below that, I would say you could probably look for a little bit near-term movement to the downside. But if it busts up and it now enters the vacuum, the tractor beam of the gap, let's not be surprised if it rallies up to either the volume ledge, that area of volume, 127.35.40, that area, or even even the gap close from the May 23 to May 24 gap. All right. So those are the two levels that I would look at. Can we take a look at Lennar? Sure. Let's stick with the trading view. All right. So Lennar, uptrend. That's number one. The most important thing I do when I'm day trading or when I'm swing trading, or frankly, when I'm doing any kind of trading, right, is spending the time to slow everything down and get an assessment of what I, by looking at the charts, see is the path of least resistance. So the path of least resistance for Lennar is up. And that would open up. So Dimitri, I would also mention that if I'm looking at Lennar, I like to get to the stock last. Index sector stock. I don't know the index is as applicable to this conversation, although a rising tide in the broader averages sure does help sectors. But this is an ITB ETF or XHB ETF conversation. So what I would say is you've got a great relative outperformer here. There aren't that many relative outperformers in ITB and XHB. Let me just show you. ITB, by the way, is the high concentration weighted version of this home construction, home builders world. XHB is not high concentration weighted. So if I take a look at where the strength is, there's a number of places we do have a little bit of strength, including ITB itself. The path of least resistance is probably higher. But remember, we are getting the mortgage rate release, I think today or this week. And then, of course, depending on non-farm payroll, we might see either a much more solidified view of another quarter point hike, which of course is going to affect yields. And that, of course, could filter down to ITB and XHB names, right? So that's what I would say with Lennar. All right. Thank you for the question. Next up, any thoughts on American Express or JP Morgan for a swing long? And has Qualcomm gone too far? All right. So, oh gosh, it's 9:23. How did 23 minutes go by? Oh my gosh. So what I'll say here real quick, XHP, no. JP Morgan, yes. XLF, be careful. If we see a rising tide in the S&P, XLF might go along for the ride. Keep that in mind. It's still a lagging sector. Tech is still the better place to go. Again, there's no such thing as too far in an uptrend, but just don't buy the high, right? If we're looking at something like that, and if Qualcomm is in a downtrend, I would look for a short, okay? I can't believe how quickly that went by. Sorry about that. I ran over. I will see you all tomorrow. Same time, same station. Be good to each other, gang. Until then.